get started. Thank you once again and good afternoon, everyone. Welcome again. My name is Fernando Parra and I have the great privilege of being an assistant professor of accountancy at the Craig School of Business, where students prepare to be the next generation of bold, ethical business professionals. I also have the pleasure of serving as director of the Institute for Family Business, a comprehensive resource center for family businesses in our community, as well as a nexus to connect with our students. As part of our mission to serve as an educational center for our community, we are offering this webinar on how family businesses can utilize employee stock ownership plans as a succession tool. I would like to thank our good friend and chair of the IFB Advisory Board, Sam Guile, for his contribution towards developing today's workshop. Unfortunately, Sam will not be able to join us today. We are also very grateful to the IFB Advisory Board and our Dean, Julie Olson Buchanan, who have worked diligently to make our resources available to our community. I would also like to recognize all of our community business partners, our IFB members, and legacy supporters for their invaluable contributions that make webinars like these possible. Today, I have the honor of introducing Steven Deis. He is the director of ESOP Advisory for Aegis Acquisitions and a legacy member of our Institute for Family Business Advisory Board. Steven is one of our own. He is a proud bulldog and a graduate from the Craig School of Business. Go Dogs.
Go Dogs.
Steven has more than 25 years of experience working with family business in our community. So let me yield the floor to our friend, Steve. Welcome, Steve.
Fernando, thank you so much. It is definitely a distinct honor to be here today. And off the top here, I want to thank all of you for taking your time to listen to this overall workshop to kind of go through employee stock ownership plans and their application within family businesses within our community from a broader standpoint throughout California and the country. And the goal today, and to have you guys out of here by right around 4 o'clock, is my intent is to really provide awareness. The most important thing as part of the Institute for Family Business and the advisory board is that our team of people on the board, it's critical for us as a group to provide, like I said, awareness, information, education to the community, to the business community, to whether you're a stakeholder or a shareholder within an individual business, you're a family member within that family business, an advisor, a trusted advisor for those individuals, or even as importantly, people that are coming up in our community that are looking for mentorship and learning about the different things that are available out there in our community. Not just here in Fresno, but more broadly from there. So what I'd like to say, just kind of starting off at the beginning here is, number one, I obviously want to wish you and your families the best. Obviously, it's been a very difficult time for our community and the country and the world the past 13, 14 months. But there have been a lot of developments, a lot of things that are occurring on an annual basis, on a daily basis, and that have been evolving in the marketplace for employee stock ownership plans, their application for privately held businesses in the local area and more broadly. And what I'd like to kind of just start off with as a premise is our discussion today. I will get into some history. I think it's good to have a foundation of where, today's modern ESOP began, how it came into existence, and the reasons why it is now being used very heavily throughout the U.S. as a business succession tool for privately held business owners that definitely need to be reviewing and understanding all of the options that they have available to them at the point in time that they are preparing or choosing to exit the business at some point, either financially or operationally. And so our intent for today is to provide you with some overview of an ESOP, how they work. It's not as well known in the community. But you'll see just from some of the things that we go through today that its genesis has been not just a 60+ year process in the making, but a 100-year process in the making to get to where we are today. An overriding premise also as well of the discussion will be the actual flexibility that's within an ESOP if you're looking to adopt one or looking to learn more about how they work, and also the control of process. And what I mean by that is that at any time you're looking to transition your business, either selling the business or transitioning it to next generation family or next generation management or other parties, it's critical that you want to be able to control a process and that things are occurring at a time of your choosing and in a manner in which you are, your preference. So we'll go ahead and go on to the first section here. And like I mentioned, kind of a little bit of the what and the why of ESOPs. And ironically, if you really look at where ESOPs began, and here again, ESOPs are employee stock ownership plans. Most people think that the modern ESOP today really had its foundation with the passing of ERISA, which is the Employee Retirement Income Security Act back in 1974. But actually, the genesis and the growth and the advocacy for providing employees within a given company with actual shares of stock or a beneficial interest in those shares of stock of the company that they're currently employed with actually began going on 100 years ago this year. If you go back to 1921, companies like Sears and Roebuck, Procter & Gamble, J.C. Penney, companies back in the early 20s actually had developed and actually participated and provided to some of their employees what are called the original stock bonus plans. And so that goes back literally 100 years from now, or 100 years from today. And the rationale behind that was that ownership was looking for a way to be able to provide benefits to employees so that they are essentially on the same side of the table as the owners of the business and start thinking like owners and creating efficiencies within the business and growing the value of the company on a go-forward basis for the legacy of the business and the continuity of the business into the future. So let's fast forward to 1956 and a gentleman by the name of Lou Kelso. And Lou Kelso is critical when it comes to ESOPs and how we've gotten to today, simply by the fact that he is well known to have adopted and put in, and he's an attorney by background and practice, the very first ESOP in the United States. And that was Peninsula newspaper. And that's even in advance of, any of the developments of 1974 and ERISA, which formalized the process for the advent of, like I said, the modern day ESOP. But what the intent was for Lou Kelso was to develop a IRS tax qualified plan that was a benefit program available for the employees, but also provided a methodology and a process to allow privately held business owners to garner the liquidity or to monetize the equity value that they've built up in their business, while at the same time and over the future providing benefits onto their employees of that stock or equity that they would ultimately sell. And so that goes back to 1956, so 65 years ago. In 1974, another a critical person to the ESOP today is a gentleman by the name of Russell Long. Russell Long was a senator. Matter of fact, he was the head of the Senate Finance Committee in the U.S. Senate, and was a big advocate for formalizing the process of an ESOP. Again, how to become more formalized, how to make it to where it would become more prevalent with companies in the community, with companies that wanted to have an effective transition that didn't involve them selling the business to a third party or maybe to a small group of employees in the company, but another option of which they can control the process and continue forward. And so that was extremely large. In 1974 was, here again, the advent of ERISA and the inclusion of the terminology and law that is still in place today for the modern ESOP. Then you need to fast forward to 1984, which goes to the law that was passed at that time during the Reagan administration that essentially created an opportunity for owners of C corporations. If you're going to have an ESOP in your company, you cannot be a sole proprietorship, you cannot be a partnership or an LLC. You actually have to be a corporation, either a C corporation or a subchapter S corporation at the time that you sell. But in 1984, with the advent of the law during that year, during the budget, it allowed for there to be placement of the C Corp option for an owner, and this is unique to ESOPs, that an owner of a privately held business that chooses to adopt an ESOP can elect, if they're a current C corporation at that time, to elect what's called a 1042 Internal Revenue Code tax-free exchange. Now that became, as you can imagine, very critical in the growth of ESOPs in many communities, and an incentive for owners of privately held businesses that the government was providing, essentially through law, an opportunity for them to either defer or eliminate the capital gains tax associated with the sale of their business. And as we all know here in the state of California, for those of you that are on the call, the capital gains rates can easily be between state and federal, between 33 and 37% of the overall sale above your basis in the company when you ultimately sell the business. Obviously, if you're selling a business to an outside third party, most likely, and in many cases, majority of cases, you will be required to pay capital gains tax upon the receipt of your asset, of your consideration for the sale. So here again, that was a big item in 1984 to provide C corporations with that opportunity. And as you can imagine, it provided a lot of incentive for privately held business owners to elect the adoption of an ESOP as a succession planning tool, exit planning tool for the company. So let's fast forward to 1986. In 1986, during the Clinton administration, at that time or previous to that time, you could not actually put an ESOP into your company if you were a subchapter S corporation. So in 1986, the law was changed, here again during a Democratic administration. Obviously, the C Corp law being passed during a Republican administration, that allowed for S corporations to now also have the opportunity to sell, for the shareholders of an S corporation, to sell their business to an ESOP and the ESOP trust, and to be able to garner liquidity in that fashion and provide benefits onto their future, to their loyal employees. The unique benefit that occurred at that time and going forward was that, under a sub-S corporation, whatever percentage of your business, so let's say that you sold 100% of your company to an ESOP and you were a sub-S corporation when you sold, your company would become a virtually tax-free company, as an example here in the state of California, other than the franchise tax or, did I jump off here? Am I still on? Yes. Okay. Or the franchise taxes, which is 1.5% here in the state of California. So ultimately, but the combination of those two laws that were passed provided owners, if they were a C Corp at the time of sale, to potentially eliminate a significant amount of capital gains tax, and to be able to finance the buyout of those shares if you were an S corporation or you converted to an S corporation after your sale, that you would have the opportunity that your company, instead of paying income tax, which would normally flow through to your K-1 and ultimately to your 1040 as part of your normal receipt of monies through an S corporation, you would literally have the opportunity to have a company that is tax-free or virtually tax-free. So you can imagine that if an ESOP is being used as a exit planning tool to buy out legacy shareholders of a privately held business, and you're utilizing an ESOP to be able to provide the buyout of those shareholders, those legacy shareholders, by having the ability of the company to virtually pay no state or federal income tax, was a substantial jump, again, in the expansion and the processes through to what we call today the modern ESOP. So to get a little bit past that now toward kind of off the history lesson, but you can see that ESOPs just didn't start yesterday. The premise behind an ESOP has grown, and the components of the modern ESOP today have grown and developed over a significant period of time through legislation, and as you can imagine, with the benefits that I just illustrated, have increased dramatically the amount of ESOPs that are in our communities to this day. To give you a little bit of statistics, and people are always a little shocked by these numbers, is that the last numbers I was able to look up is that there are about 6,500 ESOP companies, or companies where a portion or all of the company is held, of the shares of the prior owners are held within the ESOP for the benefit of the employees. And in the state of California, us being a very high tax state, over 800 of those ESOPs are just in the state of California alone. As you can imagine, with the high tax rates, as I mentioned, in the state of California. The thing that's as important of a benefit is that the amount of assets that are held in ESOP trusts today, now these are assets that is either cash or stock in the companies that have sold to an ESOP previously, is now over $1.4 trillion. So basically what we're talking about there is that's $1.4 trillion, actually it's north of that now, in assets that will ultimately be provided at retirement or at some point in the future to the individual employees as a retirement benefit. So as you can imagine, think about that for a minute. Another, big reason for ESOPs in the past and how they've gotten to this point is that owners within these businesses that have adopted an ESOP, obviously the benefits that are associated with the shareholders and the company are exceedingly important. The as important benefit and lateral benefit, complementing benefit to the ESOP of providing people that are employees in the company with benefits of this level over a broad standpoint is considerable. And the other nice factor of an ESOP is that, remember I mentioned that ESOPs were adopted under ERISA, the formalization of ESOPs. And most people are familiar with ERISA because of their 401k plans. 401k plans that you may have in your company where you are deferring a portion of your pay, and hopefully the company is making a match associated with the amount of pay that you are receiving. In an ESOP, the difference here is that the employees are not making any contribution of their own money to the ESOP for their benefit. The company is making contributions annually that allows for shares within the ESOP to be allocated to the employees over time that they have earned and can see grow as long as they're continuing to be loyal employees of the business. So as you can see, a lot of these benefits to get to where we are today came from, processes and thoughts and concepts that started literally 100 years ago this year. And lastly, in this section, many of the companies that are ESOPs, the vast majority are businesses that may have 5, 10, 15, 20 employees, 100 employees, whereas most people are familiar with companies like Winco Foods, Parsons, which is a very large engineering construction firm, Chobani. If we all go to the grocery store and we buy our yogurt, Chobani is owned partially by an ESOP. And so people have familiarity with some of the large companies that have tens of thousands of employees, but in our community here in the Central Valley, even in California more broadly, and especially throughout the US, the preponderance of companies that have adopted ESOPs, of that 6,500 that I mentioned, are companies that are going to be, smaller, closely held businesses, or what are termed middle market businesses, that are going to be, from an enterprise value, $50 million and lower. So let's go ahead and go on to the next section. So the next section is basically, why have company shareholders elected to establish an ESOP? What's the rationale? What's the motivation? I've gone through a few of them just in the discussion thus far. That, obviously a selling shareholder of a privately held business may be enticed to sell their business and to an ESOP, and have the opportunity for their employees to benefit from that equity that was sold through to the trust. It's critical for people to understand at this point that it's a business exit and succession tool, which has become prevalent with a lot of the laws that have been passed over the years. But it's also as important as an equity-based benefit for their loyal employees. And to give you guys a couple of examples, if you go back 100 years in the past, or even 65 years in the past, before the advent of ESOPs as an option, what you ended up with is that you maybe had a couple of options available to you: to sell to a third party your business, this is if you're a shareholder, or to sell your business to maybe a group of insiders or people within the company. The ESOP allowed for there to be an additional option, no one option being better than the other, but it provided another option to owners who said, I'd like to see the integrity of the business continue on into the future. I'd like to see it continue in our community in the form and fashion that it is today. I'd like to see the business, let's say it's a multi-generational business, and there might not be a logical heir that is working in the business, or there may be even a logical heir that's currently working in the business operation today. It's very clear. It's very clear through all of this that people need to have a strong understanding that there's multiple options, multiple strategies, and that it's key for each owner to make their own decision. Another factor that's important is that there's a lot of statistical information, and I'm seeing this in the last 12 months through COVID and through everything that's been occurring, obviously, to everyone. I've noticed a lot of business owners that have said, my employees, whether they were an essential services business or not, I've seen a lot of suffering occurring with these employees that have helped me get to the point to where I am as an owner today, and the equity that I've built up in my business. And instead of possibly selling the business to a third party or some other option, that I like the idea of having the ability to receive a fair market value. And by the way, when you sell your company to an ESOP, you don't have to sell all of the company to the ESOP. You can sell a portion to the ESOP. It's not an all or nothing proposition. But when you sell whatever portion that is to the ESOP, and then we'll provide those shares on to the benefit of the employees, it's important that many of them, and I've seen this, that they've looked at a lot of the studies that are out there through places like Rutgers University, the Business Enterprise Institute out of Denver, and referencing Rutgers University, one of the things that they've seen is that, and it's some statistics that I keep reading and they've really kind of blown me away, is that 28% of senior citizens, and I hate to use the term senior citizens because it's going to include my age in this example, is in US that are retiring between age 51 and 61. This is 28% had zero financial assets when they passed away, if they were at that point in life. And then another 36%, so a combined 54% of people that were polled or that were brought into this study had at most $50,000 of assets to their name at the time that they may have passed away or retired. Another number I'm going to give you, and this all goes toward the decision-making process of not just the benefits for the owner, but the benefits to the employees, is the number $1,496.13. In the state of California today, I just checked this, the average Social Security check in California is $1,496.13. Now, whether you're living in Fresno or Bakersfield or Sacramento or San Francisco or LA, being able to retire with dignity is very difficult, especially if that is the predominant amount of your retirement benefits as an employee. So what the ESOP has provided for those companies that have those participants, and in just this last year was reviewed, there were about 250 ESOPs put in that given year. I believe it was 2019. There were 31,000 new ESOP participants that year that are receiving now benefits through the ESOP. So a lot of the statistical numbers that have been done by Rutgers, what they really point out is that there's an opportunity through employee ownership, and most people are familiar with employee ownership of, I work for Apple, or I work for Google, or I work for whoever that company may be that's a public company. The ESOP has provided opportunities for privately held businesses to stay privately held businesses and provide an equity component that the employees can participate in and benefit from as they go forward and into their retirement. So you can imagine, if you have monies that are coming through for Social Security, hopefully you've paid your home off by the time that you retire. Hopefully you've been putting away money diligently in a 401k plan that you've been participating in with your employer. But the third component, or a big component, and obviously other money you've saved, is this pool of money that can accumulate as to the stock value and the stock that you've received and been allocated while you've been an employee of the business. And what I've seen personally are many employees with these companies that have been around for many, many years. There's a saying at Winco Foods, when you go through the checkout line at Winco, always be very polite to everybody, but always be polite to your checkout person, because literally the assets in the Winco Foods ESOP plan today on behalf of their employees is over $1 billion. So be careful. The person you might be helping check out your groceries that day might be a millionaire that's garnered that equity in the stock of Winco Foods. Now that's a unique example. There's no guarantees of $1 million payouts when somebody does an ESOP, but even having a relatively small amount, whether it's 20,000, 30,000, 50,000 that you've built and accumulated and participated in that value creation through your company, has been exceedingly important, and you've been able to benefit from that as an employee. So back to this point, there are tremendous benefits on behalf of the selling shareholders that are unique to ESOPs. The exchange that you can participate in and possibly avoid capital gains taxes, the ability of the company to essentially pay back any financing or the buyout of the legacy shareholder shares with not after-tax dollars, but with pre-tax dollars. Because we all think about it today, if I make $2 million in my company and I'm an S corporation shareholder in the state of California, the high probability is half of my earnings have gone out for tax, or the monies that I would receive. If that money that would have gone out for tax to the IRS or to the Franchise Tax Board can be accumulated in the company and be used to pay for the shares that were acquired by the ESOP on behalf of the employees at a fair market value, can be a significant win for the employees, the company, and obviously the selling shareholders that have built these wonderful businesses in our communities and would like to retire, or maybe 2 feet in, 1 foot in, or maybe they can transition away at their choosing. And so a big part of it, and I'll get to some questions here at the end, a really big part of what I see with owners is I'd like to be able to stay involved in my company. I'd like to stay involved as long as I choose. I'd like to step away when it's at a point in time of my choosing, and not because it's dictated to by, I sold my business and I've got a year contract with a new acquirer, and then they'd like you to step away. And by the way, nothing wrong with that solution at all. There's every solution that's out there, and there's many. The ESOP provides just one option for people that are out there that's unique, and we just want to make sure people are aware of that option. Fernando, we'll go ahead and go on to the next section. So how can a properly structured ESOP become an integral part of the ongoing culture and sustainability of a company into the future? I thought it was important through this part of kind of the discussion and awareness that that it's very important to understand, okay, we've gone through, we've done our diligence, we've worked with our trusted advisors, which I heavily, promote to people on a daily basis, whether it's an ESOP or any other solution. About 80% of business owners out there, this is through study as well, believe that a written plan of their succession or transition, both financially and operationally, is critical to their business. But the statistics actually, if you go back and you ask companies and shareholders, have they actually done that? The number is actually about 17%. So there's a dramatic difference between the two. And so going to what, so we've gone through the process of exploration, we've gone through the process of looking at all the options. The companies have worked with their trusted advisors. We've decided to adopt an ESOP on behalf of our company and for our employees, and for the ultimate monetization or liquidity for the owners that are within the company. And now what happens? So now we're an ESOP today. And the unique thing about an ESOP is that a big part of it, people always ask me this question, so what does the company look like after I've sold to the ESOP? And the big issue here, and the big question is that, will my company keep the integrity of our mission of our business? Will it stay in place for the long haul in our community? Is it going to be able to maintain the culture that hopefully we've built up to this point? I find that many companies that have successful ESOPs for many, many years in their businesses are those that already have a very solid culture within their business. But there's also many companies that are trying to enhance their culture within their business and providing an opportunity to have a transition that may be less unsettling to, obviously, the company as a whole, senior management, the broader base of employees within the company, and the business in the community. One thing I've noticed in many transitions that have occurred in the past is that, can we keep, here again, I'm going to keep kind of harping on it, but keeping that integrity of the business. And I'm going to give you another statistic, which I apologize for, but I thought this was one of the best I've seen, and it's apropos to today. There was a recent study done by Rutgers University that stated that through COVID, so literally through the last 12 to 14 months, as we've all been fighting through our companies, our families, our loved ones, everyone through everything associated with COVID, that companies that have an equity component or an equity-based plan, an ESOP or some other equity-based plan, where the owners have some skin in the game. They have some ability to see the company grow and prosper more than just the pay and the benefits and hopefully their love of working for the company they're currently employed with. That companies that had that ended up on a 4-to-1 basis, maintain the jobs within their companies better and to a much greater extent than companies that did not have that as part of their broader base of kind of an equity-based program for their employees. And I've always thought of what really brings that home is that you've through that culture, through the sustainability of the company going forward, is that not just the owners of the business or the prior legacy owners of the business, is this company critical to and important to them that it grow and prosper, it be well beyond them into future generations. And we all know how hard it is to be able to pass on a company generation to generation. What's big and important to them is that through that culture, through that sustainability, that everybody just works as a collective. People look at efficiencies. People look at ways that we can continue the business and make it through difficult times. If you look at the last Great Recession back in 08 and 09, there were also additional studies done back then with ESOP companies and non-ESOP companies, and companies that were ESOP-related businesses or had equity-based components to their compensation performed at about 25% better than companies that did not. And I think it's that collective that I think becomes very important for a lot of the employees. It becomes important for everyone associated with the company. And everybody is fighting forward, moving the ball in the same direction instead of concentrating on the difficulty of the period that we might be confronting. And this also gets to, and it'll be a question that'll be in our section 4 here, but I'll say it now, is what happens if you have an ESOP in your company and there's a difficult transition, a difficult time happening. Maybe there's a recession or a pandemic or a very difficult period that it's a very cyclical business, or maybe a company lost a key customer that they've had to now replace. The fortunate thing within an ESOP is that here again, kind of toward that process of culture and sustainability, is that the existing former legacy shareholders, let's say they're still being paid for their equity that was sold back at the original transaction, is that they have the ability to be quite flexible. If it's a quarter that you're going to have a difficult period, or 6 months, or a year that you may foresee there being difficulty within the business. And so I've seen many companies where they've actually, because of the flexibility, this is back to the points I made at the beginning, is flexibility is extremely important when you're looking at putting in an ESOP, because an ESOP is not a black box. It's not formed the same way for every company from one to the next. They are very different from one business to another. The benefit to that is there's a lot of options, which can sometimes create complexity. The other benefit is that you can tailor the plan more specifically to the needs of the selling shareholders, to the company going forward, and to the employees. And so that's from a flexibility standpoint. And then on to one of my other points was control of process. And this gets also to culture and sustainability, is that the control of process is important in that when you sell to an ESOP, the process that is gone through to be, to determine the price of the equity for the company and to negotiate with an independent trustee to determine the value of the company, you as the selling shareholders control that process. We don't have to go out and find an outside buyer. We can control the process and the time associated with how quickly the transaction may occur. And it doesn't matter whether you're doing a sale to a third party or a sale to insiders or you're selling to an ESOP. It's important that everybody crawl, walk, run. In other words, and it's kind of a saying I have for people, is it's extremely important that in all options, ESOP included, that we not only become aware of options that are available like an ESOP, but we take time to educate ourselves and understand what application, if any, each of those options may have for the individual employees that are within the company and for the selling shareholders. And we'll go on to the last section. So basically where we're at now, we'll go one more. So before we get to questions, which I'm looking forward to going through your questions, I thought I would kind of walk through a variety of questions that I typically get asked by individual owners that are endeavoring or looking at an ESOP for their business as a strategy, the trusted advisors, CPA, legal counsel, trusted financial advisors, key people they may know in the community that are confidants of theirs, and also the employees when we ultimately may put in a plan, the type of questions that they may come up with. And one of the questions I always get is, well, if the shareholders may not have to pay any capital gains tax, and the company theoretically, in this process, if structured that way, may not have to pay any income tax on a go-forward basis. So when is the tax paid? How is that all handled, and why is that being done? Why is the government and the legislature provided laws through over multitude of administrations to the individual? In other words, why have they foregone that tax? And so this gets back to, over 70 years ago. If you look today we have many people that are part of the baby boomer generation, that those folks that are born between, say, 1946 and 1964, that are at that age where they're exploring their retirements from their businesses. And I think a little bit of foresight back at that time, way back many years ago, is that you can foresee in the future that there's going to be a lot of people that are, one, looking to exit their business and looking for options, and two, there's a lot of people that will be retiring, and we only know that Social Security, Medicare, and other benefits will only go so far. So what's commonly happened, and this is what is typical of any ESOP, is that early on in the process, obviously there are all those tax benefits for the selling shareholders and for the business as a whole to help finance the buyout of the shares from the selling legacy shareholders. But ultimately, think about this. I gave a statistic a little while ago that there are about $1.4 trillion in assets that are in ESOPs that are in employee accounts for the benefit of those employees. So what typically happens is that an employee retires, that employee can roll that money over to an IRA account. They can continue in the company and roll over the benefits that they would have received via the ESOP to the 401k plan, or if they went to another company. And so as the employees, and remember, they paid zero for the benefit of these shares at the time of they were allocated to them, that 1.4 trillion, an ever-growing share, is going to be money over time that as employee participants end up pulling money from their IRA accounts or their 401k accounts, that they are ultimately then at that point going to pay income tax on those proceeds as they are paid to them from the value of their accounts of the ESOP. And so what the legislature and a lot of the modernization of ERISA and a lot of the changes to ESOPs through to this day, which there's a lot of bipartisanship when it comes to ESOPs. I give the example, there's a piece of legislation out today that some of the sponsors of the ESOP are Ron Johnson from Wisconsin, a Republican, and Kristen Gillibrand from New York. And knowing our current politics in the world today, and knowing the dynamics between both of those individuals, they are both advocates for and benefits for not only owners but also employees. But you find a lot of bipartisanship in a lot of the new laws that are being put forward today, and hopefully passed in the future to further evolve ESOPs as you go forward. So the unique benefit here is the employees do not pay tax as they're accumulating their value in that stock. The other part of it is that I went through a little bit, if there's a dramatic downturn in the company, there's flexibility associated with the business and any indebtedness that was involved with the sale of the equity originally from the legacy shareholders, which is very important. It also provides a lot of flexibility. I get questions from individual trusted advisors, to walk through the different dynamics of the tax savings and benefits that are associated. The other question I ask is well, what is the downside risk of putting an ESOP into my company? The downside risk that I've seen in my experience is if the company was overvalued at the time of the sale, if the company was, in other words, that the valuation that was provided as sale to the existing legacy shareholders was in excess of what should have been the value, and now it's too difficult for the company to be able to cash flow the payment of the debt associated with buying out the shareholders. That can create obviously significant trouble for a company. The importance is that the process that's involved, having an independent trustee that is being negotiated with at the time of sale, having an independent valuation done so that the trustee can have an independent value of the business, and that legal counsel is associated with either both the sell side of the transaction, which would represent the company and the selling shareholders, and legal counsel for the trustee as the fiduciary. It's in the best interest, as ESOPs have evolved here, that the price that's paid for the shares is fair. It's a fair market value that's sold for, and that it's not providing any detriment or negative aspects to the company on a go-forward basis. So that's a really critical piece. I get asked that on a regular basis. That's a really big one. And the other thing I get asked quite a bit by employee participants is that I've literally been asked, can I choose not to be in the plan? Well, and I always explain to them that there's no downside benefit for you to be a participant in the plan, as long as you are employed by the company, you continue with the company, you're a loyal employee going forward, you'll continue to receive allocations of shares, and you will ultimately be a beneficiary of those shares. And the employees also, we drill down on, and this is for the owners or shareholder legacy as well, is that just like a 401k plan, the individual participants are going to have vesting schedules. So in other words, it's not that shares go to an employee and it's their shares immediately, but it's going to follow a vesting schedule that oftentimes mirrors what you have in your current 401k plan. So here again, the big difference between a 401k and an ESOP, they're both under ERISA, they're both under those guidelines, but an employee stock ownership plan is the primary asset that's held in the trust for their benefit are shares of the company that they work for, and they are beneficial owners of those shares. So that's a common question that I get as well. So to kind of, let me get a drink of water here, guys. To kind of encapsulate things all the way to the end, one, I want to thank Fernando and the Institute for Family Business for having the opportunity to provide some awareness on an exit or a succession strategy that is very prevalent throughout the U.S., but it's typically about 8 to 10% of the divestiture transactions in the U.S. each year are ESOPs. So it's an important one for everyone to know. But back to my original point is that if you are a first generation owner of a privately held business, if you're a second generation, third, fourth, fifth, sixth generation owner of a business, whether it was in your family, whether you acquired the business at any point in the past, please, I implore everyone, please work with your trusted advisors. Please work with them to make sure that you can have those written plans that states that if something happens adversarially to me, something bad happens to the selling shareholders, this is how things will be handled. If the company goes through a process that they are selling either to a third party or to an ESOP or to internal managers, it's at a time and place of their choosing. I find that to be the most critical thing when I meet with people in the community, whether it's here in Fresno or throughout California or on the West Coast or nationally, people that I speak with, it's that they desperately want to be able to have a transition that's at a time and place of their choosing, and that they fully understand the benefits, the downside, any ramifications of the options they select. So again, to go back to my beginning point, most privately held businesses will be sold at the legacy level one time. That's if you sell the whole company, or maybe you break it up into individual pieces and sell it in multiple pieces. But it's extremely important that you plan. It's extremely important that you utilize your key advisors that are in the community, because they are there for you. And again, I'm hoping that this information was helpful. I tried to keep it where we're out of here by around 4 o'clock. I don't know if I don't know if we're close on that. Oh, it's almost 4. So definitely would love to open up to questions. And at the very last part of this slide, there is obviously, if there's information that was of all of interest, or you'd like to find areas to explore things further on ESOPs as a succession tool, the Institute for Family Business is here as a place of education, advocacy, but not for sales. It's not here to sell you an option or sell you an alternative or anything of that nature. The Institute for Family Business is here to provide service to the community. And as you can see, there's some emails that are here at the end, myself as well as Fernando. And the nceo.org is the National Center of Employee Ownership, which is actually located here in California. And they have a multitude of information on not just ESOPs, but equity-based plans that are prevalent out there in the community for the benefit of the owners, the legacy owners, key management, transition management, and the broader base of employees. So anyway, Fernando, thank you so much for the opportunity, and thank you everyone for taking the time today. Look forward to your questions.
Thank you, Steven. We actually do have some questions, and I open up the floor. I open up a Google document for people to actually share those questions with us, or you can simply use the chat or raise your hand, and I'll yield the floor for you guys. The first question we have is there a union? No, sorry. If there is a union in a company, are there considerations for the part of the company that may prevent it from becoming an ESOP?
Very good question. And there's a couple of ways when it comes to companies.
Let me make sure you're.
Can you hear me okay? All right. So now I'm unmuted. So relevant to unions, what typically happens when you put in ESOP, so to answer the question initially, there are no any major issues with placing ESOPs within a company that that currently has a union as part of the components of the workforce for the company. We've worked with numerous, I mean, if you look at it, there's a lot of construction firms that are ESOPs on a national basis, and even here in our community that have unions. Typically the choice by the ownership and the company is they can do one of two things. They can exclude the union employees, and the participants in the plan would typically be the administrative and, as an example, in a construction company, administrative folks, estimators, foremen, other people that may not be part of the union but are employees of the parent company or the existing business. They will be able to be in the ESOP and be participants, but frequently the union employees are excluded from being participants in the plan. One thing I will add to that is that I've seen in cases at times that the individual companies will sometimes, and here again, the relationship between companies and unions is extremely critical, but I have seen situations where there are people that are within the union that upon awareness of the ESOP may elect to become an employee of the company versus being part of the union. I do see that happening. It's less frequent, but there is nothing at all stopping a company that has union employees or even a preponderance of union employees adopting an ESOP.
Great. As a follow-up, Steve, can a union employee become an owner under the ESOP?
So thank you for the question. So what that goes to is it would be a situation where a person that's part of the union. Now, here again, it's a very delicate process. We have seen people that are part of the union being involved within an ESOP. There are multiple options there as to what can occur. Traditionally, those parties are excluded, but I have seen people that are part of a union also be part of the ESOP in the company. It all gets down to a very, very cautious negotiation between the parties and the union to make sure that you're not creating any ill will or otherwise by being part of the union as well as being part of the ESOP as well.
Do we have any other questions?
Can you see me, Mr. Parra?
Yes, I can hear you.
Okay, I have a question. For small companies, how doable it is to have a profit sharing plan versus having a full-fledged ESOP? And any downside to creating a profit sharing plan for key employees?
Thank you for your question. Basically, what we've run into is that you can have a 401k profit sharing and an ESOP at the same time. They do have different components to them, obviously. One is going to be employer-based securities or employer-based stock. The other is going to be obviously monies that may be allocated to the participants. But what we've traditionally done is that companies will continue with some sort of profit sharing associated with the company, with the plan. There's always a very delicate balance, and we do a lot of that review, is what benefits are you providing today prior to the adoption of an ESOP? And you do not want to create a negative connotation of the ESOP by removing benefits that might be existing today currently through the 401k as a match, as an example, or through a profit sharing. So it gets down to some discussions on the math that's associated and the benefit being provided. I have seen companies that in lieu of the profit sharing contribution, they will basically be providing that allocation onto the ESOP instead of the traditional profit sharing that they've been doing previously. I would just say that it's a choice. I've seen it in both directions. It also goes to expand on your question, it also goes to bonuses. A lot of companies pay year-end bonuses, as an example, to their employees, either for safety or other work that they've done within the business. You don't want to curtail existing cash bonuses, things that are customary in your company that are expected items if they're earned by your employees that are there within the business. So I'm not sure if that answered your question, but it's a choice as to how you handle the combination of a profit sharing 401k plan and an ESOP, but you can have both within
Thank
your
you so much. Thank you.
You're welcome. Any other questions anybody has? No? I think we're all good.
Then thank you very much, Steven, for this wonderful presentation. Again, as Mr. Deis mentioned, it's all about making sure you find the right information through your advisors. So feel free to reach out to us or Steven in this case, if you're interested in ESOPs. Stay connected with us. I hope that you found this information useful. And don't forget to become a member. Your contributions are what makes these seminars possible. So thank you once again for attending today. Steve, thank you. And thank you all.